So I want to thank the American people for the extraordinary honor of being elected your 47th president and your 45th president.
Hello and welcome to the week ahead on Nomura Podcasts. It's Friday, the 8th of November, and I'm Dominic Bunning, head of G10 FX strategy for Nomura. I'm delighted to be making my debut as host of this podcast in what has been a monumental week in global politics and financial markets. I'll be joined by David Seif, our Chief Developed Markets economist, and Jing Wang from our China economics team to talk through the major implications of the US election and China's National People's Congress. Well, it's been quite the week, both in markets and politics. In the early hours of Wednesday morning, it became clear that Donald Trump would win enough electoral college votes to earn a second term as president, enjoying victories in the key battleground states and a notable swing in the national vote share.
This will truly be the golden age of America. That's what we have to have.
The Republicans also took the Senate, and the House of Representatives looks like it's coming under Republican control. And financial markets were quick to react to this news, with the notable Trump trades generally moving as expected. We saw the dollar strengthen, US yields rise, and equities also rally. Since then, we've seen a little bit of a stabilization and even a reversal in some of those trends, which does suggest the market was somewhat prepared for this outcome. But it does not mean that there are no further implications, and we will get into that more a little later. Elsewhere, we've also been keenly watching China, with the National People's Congress currently in session as we record this podcast, and with policy decisions there likely to shape investors' perceptions both on the outlook in China but also in terms of the broader impact on risk sentiment and global growth dynamics. Finally, we've had interest rate decisions in the US, UK, Norway and Sweden to digest, and there's been some volatility in Germany's political backdrop too. So without further ado, let's get stuck in.
This is a magnificent victory for the American people that will allow us to make America great again.
So let's start with the US and our Chief Economist for Developed Markets, David Seif. David, thanks very much for joining me. We'll get straight into it. Donald Trump is going to get a second term. The Republicans have won the Senate, and it seems very likely they will control the House as well. What do we expect the new administration's major policies to be, and how does that impact our growth and inflation outlook?
Yeah, well, wonderful to be here as always, Dom. So Trump has won, and it looks very, very likely that the Republicans have full control of Congress. So we think that Trump will implement tariffs very much along the lines of what he campaigned on, and also that there will be a full renewal of his expiring tax cuts from 2017. Now, to be clear, the tariffs are something that Trump did not need to win Congress in order to push through. The president has wide authority to do that. But the ease of renewing his taxes or his tax cuts will be much, much higher, assuming that the House does stay Republican, as looks like is the case right now. Now, we think that the tariffs are negative for growth and also serve to push inflation up. And so, that is somewhat offset by the certainty that we think will arise from the fact that it will be easy to renew these tax cuts, and there'll be fewer fights over fiscal policy as a result of a unified control of Congress. So that does somewhat limit the negative growth outlook, which we see as only detracting 0.2 percentage points from 2025 growth versus what was already a fairly strong baseline. So, still very firmly in expansionary territory. We do see that is a bit backloaded once the tariffs go into place. So we do see growth declining in the second half of 2025 especially, but certainly never turning negative. We also think that the tariffs, as I said, are a real inflationary impulse and are likely to add about 75 basis points to inflation in 2025, also backloaded to the year. So we think that assuming the tariffs go into place pretty quickly, which is our base case, that we'll start to see that impact by late Q2, and that will carry on through the rest of 2025.
So we're going to get higher tariffs alongside a continuation of those tax cuts, meaning slightly softer growth and a higher inflation outlook. Now, we're recording this just after the Fed's November meeting. How does all of that play out in terms of our Fed view from here?
Great. Well, we significantly modified our Fed view following Trump's victory. And today's Fed meeting doesn't really cause any major additional changes to that. We still expect the Fed to cut in December, as had been our base case prior to the election, then skip January and cut in March. All of that is unchanged. However, because of the impact of the tariffs, we now expect there to be an extended pause from the Fed, and think that one cut in March of 2025 will be the only cut that the Fed is able to make that year. So that leads us to think that at the end of 2025, the Fed will still have a Fed funds rate of 4.18%. Now, once we get into early 2026, we think the main inflationary impulse from those tariffs will have faded, and it will lead the Fed to be able to cut twice more, once in Q1 and once in Q2, leading to a terminal rate of 3.58%. So a couple of things to just note about how that has changed versus our prior view, which did not assume tariffs. The first thing is that it's a higher terminal rate. We had previously had 3.18%, and now we have 3.58%. And I think maybe more notably, an extended pause and only a single cut in 2025. So, I would also point out that part of the reason that we raised our terminal rate, that doesn't have much to do with tariffs, because we think that the impulse from them will, as I said, have faded in 2026, the inflationary impulse. But the key thing is that with what we now expect to be the full renewal of Trump tax cuts, that does lead to stronger growth and also bigger budget deficits, which is stimulatory for growth, and we think will lead the Fed to hold rates higher once it reaches its terminal rate.
Okay, great. Thanks, David. That's quite a significant shift. And I'd also note, still probably a little bit more hawkish, the market pricing, certainly for the next 12 months or so. Okay, so that's the sort of longer term outlook. But, in terms of next week, we do get inflation data and retail sales. Are you expecting anything notable out of either of those releases?
Yeah, we expect a relatively hot inflation reading of 0.344% on a core basis for October, and that's up from 0.312% last month. So both would round to 0.3, but a non-trivial increase. A lot of that is due to goods prices, and a lot of those goods prices are actually due to the highly volatile used vehicles prices category. Incoming data do point to used vehicle prices continuing to be strong in October. And then also that some transportation services prices, such as auto insurance, motor vehicle maintenance, and airfares, probably were also a positive. So we still expect that supercore services prices will go down. So we think that those will fall to 0.348% in October from 0.404% in September. And we also expect rent and OER to remain relatively subdued in October. But overall, because of the increase in goods prices, we think that's going to lead to overall core inflation to be higher in October than it was in September. In terms of retail sales, we have a pretty bullish reading for that. We think headline retail sales will be 0.6%, and the control group will be 0.4%. So a lot of what is driving strength in retail sales is auto sales, sales at gas stations. And then there was also Amazon Prime Day deals in October, which were an additional tailwind to that. Based on our estimate of the retail deflator, we would therefore expect real retail sales on a headline basis to have grown at 0.5% month over month. So we are above what is currently the consensus. That consensus may change because it's still early, but it would be another strong month for retail sales and another indicator that the economy in the U.S. is quite strong, and that probably the weak employment report that we got at the beginning of this month was really just due to temporary factors from hurricanes and strikes that have mostly now been settled.
Great, thanks, David. So US economy still firing on pretty much all cylinders and some pretty seismic changes potentially coming in 2025. Thanks a lot.
Indeed.
Moving on to Asia, I'm delighted to welcome Jing Wang from our China economics team. Jing, what do you think the policy reaction will be in China to a Trump presidency?
Thank you, Dominic. Happy to be back again. Regarding this Trump victory, we think the implication on China in the very near term in terms of economy and policy could be rather limited. China will very likely to continue its stimulus plan, which has been implemented since in about a month. But in a relatively longer term, given these large tariff hikes, as high as 60%, presumably, somewhere in the middle of next year, if there is a sharp slowdown in the export sector, which will lead to much big pressures on growth, in that case, Chinese government is very likely to implement a larger package of stimulus to partly offset this adverse impact from this export headwinds.
And moving on to domestic policy, as we record this podcast, the NPC is currently meeting, so we don't know exactly what we're going to get from them. But from your perspective, what do you think we need to see in order to generate more of a stabilization or even an improvement in what has been quite a challenging growth environment in China recently?
Yes, sure. So given this huge fiscal revenue gap and the finance minister's pledge to meet the fiscal targets, we have been expecting the Chinese government to approve about 1 trillion extra borrowing for the rest of the year. But definitely this is not enough. To better revive the confidence of economy and markets, we believe Beijing will be eventually need to introduce more funding to address the home delivery issue and also more funding to ramp up the spending related to social security for the low-income households, which could eventually lead to higher consumption for the overall economy.
Thanks. That's really interesting. Now, in terms of the near term, we do have some data out of China this week. We've seen a little bit of a pickup in the PMIs recently. How do you think next week's data in terms of retail sales, industrial production will look? Are we going to see more of an improvement there as well?
Yeah, definitely. We have already some signs of those stabilization for PMI and the new home sales. And given those high-frequency data, we expect those major activity data for October to improve modestly from September, including IP, retail sales, and fixed asset investment. But we think this is still definitely not enough for Beijing to achieve the growth target for this year, and definitely more forceful measures are needed to addressing those overhang issues in the property sector.
Great. Thanks for joining us on the podcast, Jing.
Thank you.
We'll finish this week with Europe, and we're recording this in the aftermath of 3 divergent central bank decisions, all of which were largely in line with expectations, but each with interesting implications, especially for currencies. The Norges Bank left interest rates unchanged at 4.5%, where they have been since December last year. And they also guided that we won't get any rate cuts until Q1 2025. Meanwhile, the Riksbank in Sweden cut 50 basis points to 2.75% and also guided towards further easing this year and early next year, citing subdued local demand. Now, this ongoing rate divergence really supports our FX view that Noki Stocky should be moving higher. And we'll get a bit more information next week as well from Norway's CPI data on Monday. That's generally been a bit stickier than many of its peers, and that's something we expect to persist and support that view of the currency pair to move higher up towards parity. In the UK, the Bank of England cut interest rates 25 basis points, but there was a dissent in favour of leaving rates unchanged, which was largely in line with the consensus and exactly in line with our own economists' forecasts. We did see that fiscal loosening from the recent budget feed into some upward revisions in the bank's growth and inflation forecasts, and I think that makes the path for further easing a little bit less clear than for some other G10 central banks. In FX, we see euro sterling moving lower as a reflection of that macro and rate divergence. Now, moving into next week, no major central banks, but we will focus on some of the survey data in the form of the ZEW surveys. They're likely to show a little bit of a stabilization after we've seen similar trends in other recent survey data. We'll get a bit more detail on euro area GDP for Q3, and that surprised to the upside initially on the first release. And we'll also get GDP data for the UK as well, where we expect a slight deceleration from Q3. Also in the UK, labour market data is due, with wage growth unlikely to have slowed significantly, and that's one of the things that is going to keep the Bank of England on that slightly more hawkish path in our view. And then finally, not wanting to be outdone by the US political stories, we're going to be watching German politics very closely, where the governing coalition appears to have cracked and there are risks of early elections being called. At the moment, it seems like March is likely to be the date of those elections. So that is something to watch next week. Well, that's it for this week. Thank you for joining us at Nomura Research on the week ahead, edited and produced by John Dalton. If you enjoyed the content, please like and subscribe to Nomura's podcasts on Apple, Spotify and SoundCloud, or your usual podcast provider. We'd love to hear your feedback, so feel free to leave a review and share this episode with your colleagues, friends, family, long-lost acquaintances, and anyone you think might be interested. You can also head to nomuraconnects.com to keep up to date. Thanks again, and good luck for the week ahead.
In a complex and unpredictable world, where a sunset in one market means a sunrise in another, one investment bank always looks beyond the horizon to help our clients release the potential of tomorrow, today. Nomura. Connecting markets, East and West.
Disclaimer. This content has been prepared by Nomura solely for information purposes. It is not intended to form the basis of any investment decision and is not an offer or solicitation of an offer to buy or sell or enter into any agreement with respect to any security, product, service, including but not limited to investment advisory services or investments. The opinions expressed in the content do not constitute investment advice, nor is legal, regulatory, accounting, or tax advice, and may change at any time without notice. You should seek independent advice as appropriate for individual circumstances. For further information, disclaimers, and disclosures, please visit Nomura Connects at www.nomuraconnects.com.